to the Mortgage Rate Weekly Market Update for the week of October 1st, 2018. Hello, I'm John Thomas with Prime Residential Mortgage. Going to give you your update. Well, last week we did see mortgage rates move slightly lower. If you take a look at the bond chart on the screen, mortgage bonds have been selling off since the end of August, which had been moving interest rates higher. But then you can see right about September 20th to the week of the 24th, they're able to find a floor of support and rally higher off of that last week. So you can see the short-term trend for bonds to move higher, which move interest rates lower. That was the leash effect we were talking about, pulling the bond back towards a 25-day moving average. But then on Friday, you can see that red candle there. Mortgage bonds at the end of the day sold off, and the Treasury, U.S. 10-year Treasury, the rate actually moved up. So on the technical trading pattern, that is a bad sign. It signals that mortgage bonds could potentially sell off and that U.S. Treasuries interest rates could move higher. Both of those are bad news for mortgage rates. It would move the rates higher. So on Friday, we issued a lock alert to all of our clients. Starting the week, if you're cautious, we're going to recommend going ahead and locking your interest rate because mortgage bonds could be pulled lower down to that first floor of support. And if it breaks through that, that would be bad. We'd go all the way back down to where we were the previous week, testing another floor of support. So until the bond conventionally rallies higher, here we're in the middle of a trading range, I would recommend locking your interest rate. Take advantage of the little blip we got last week because as we get close to the end of the week, the news is probably going to move mortgage bonds lower, which will move interest rates higher. So go ahead, if you're cautious, lock in your mortgage interest rate. If you want to see if you can get something, you could carefully float and see if we bounce off that floor of resistance right there we showed you on the graph, but I would recommend locking. Now, if we dig into the economic news, we had the final reading of gross domestic product for the second quarter of 2018. It came out at 4.2%, unchanged from the second reading. It's the highest GDP in 4 years. It will take, if we take the Q1 reading and the Q2 reading and then project those out to the end of the year, it looks like we would be at a 3.2% GDP for 2018, which is a very solid number. 3% is good. So we'll see how that plays out. Then we saw the Fed's favorite measure of inflation come out last week. That's the Personal Consumption Expenditure, the PCE for short. So that was released for August 2018, and it showed headline inflation was up 0.1% from July, but the headline decreased from 2.3 to 2.2% year over year. So that's showing inflation stable and tame right there. That's good bond-friendly news. So that is what helped mortgage bonds last week. Then we saw weak initial jobless claims come out on Thursday. Claims did move up 12,000 to 214 for the week. The previous week was revised higher by 1,000 from 201 to 202. But even though we moved up 12,000, jobless claims are ridiculously low. It shows a very tight labor market. Employers are still hanging on to good employees. And we're expecting to see some wage pressure, both inflation on Friday's jobs report. That's why I'm recommending locking, because if we see wage pressure, growth, inflation, you're going to see the bond market sell off pending any other news, which will move interest rates higher. So if you are floating, the closer you get to Friday, you want to consider locking. Then we saw in the week ahead, we've got consumer confidence report on Tuesday, which is tomorrow. Then we've got weekly initial jobless claims on Thursday, and then we've got the big September jobs report coming out on Friday, and we expect that to be bad for bonds because we hope, well, not hope, but we do expect to see some wage growth, pressure inflation, which will be bad for bonds. Now, if we dig into the housing news, we saw new home sales rebounding. We're up 3.5% from July 2018 to 629,000 units on an annualized basis. That's after 2 months of decline. Now, the median sale price for new home was up to $322,000, which is a 1.9% year-over-year increase. And new home sales, get this, are up a whopping 12.7% year-over-year. So new home construction is doing very well. Looks to continue that way. It has a strong inventory, about 6.1 months supply, so very good there. Now, we did see pending home sales report for August 2018 come out. That was down 1.2% to 104.2 on the index, whereas last month for July, it was 106.2. So pending home sales measures the number of signed contracts on existing homes for sale. So it's a leading indicator of existing home sales. So it looks like they should be dropping a little bit based on this pending home sales report in the coming months. But pending home sales are also down 2.3% year over year. And that's likely because we got higher home prices, higher mortgage rates, and a very low inventory of homes for sale. But it's still a good, strong housing market. It's going to push home prices up, even though we see pending and existing home sales dropping off some. It's because of factors that are going to push home prices up and create a healthy housing market. Then we saw the Federal the Federal Housing Finance Agency, or FHFA, Home Price Index was released last week, and it showed home prices rose 0.2% in July from June, and year over year appreciation decreased slightly from 6.5 to 6.4% on an annualized basis. But if we dig into the local market here, which is the South Atlantic region, the South Atlantic region was up 11% in July from June and is up 7.3% year over year. So the South Atlantic contains Delaware, Maryland, and Virginia. So doing very well there. That market has lagged for a while. It looks like it's now catching up to the rest of the country. We're going to have some nice, strong home price appreciation. Now, in the local news, we got the next first-time homebuyer seminar in Delaware. It is Newark, Delaware, Saturday, October 20th from 10 a.m. to noon. And then the following week, we're in Wilmington, Delaware from 6 p.m. to 8 p.m. on Wednesday, October 24th. You can register for either one of those events or give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerseminar.com. And then in Maryland, we are in Hyattsville, Maryland, Saturday, October 27th. And that's from 10 a.m. to noon. You can register for that event. Give us a call at 410-412-3319 or online, www.marylandhomebuyersseminars.com. Look forward to seeing you guys next week.